brings April showers, May flowers, and a flurry of annual reports. I always love to see what stock I own have to say about themselves in this ritualistic document filled with financial information, different types of narratives, and lots of pretty pictures. The amount of detail and the level of complexity in the financial section have grown considerably in response to the increasing onslaught of accounting rules and regulations. As a shareholder of several companies, I receive many updates and reports. Even though I know how to dissect the financials and pull out any relevant ratios, I am not satisfied with the story that these reports tell me, nor I would suggest are most shareholders. Many choose not to receive an annual report at all, online or in hard copy, and few of those who do actually read don't know what they get. Who can blame them? What we want to know simply isn't there. We want assurance that our investments are secure, of course. But more than that, we want to know the health of the companies we are investing in. We are looking for a holistic view just as we are when visiting the doctor for a checkup. And to get that, we need more than the financial equivalents of blood pressure and temperature readings. So, how should we read an annual report? First, we will understand what exactly is annual report. A company's annual report is the single most important way for potential investors to understand the financial state of a company. A company's annual report is also a marketing tool designed to attract investors, and a company will attempt to present themselves in the best light possible without violating any regulations. Annual report versus 10K filing. Typically, a company will file both an annual report and 10K report. An annual report is the shorter version that often comes with illustrations, glossy pages, a letter from the chairman or CEO, and an overview of the financials. The 10K is a longer, more thorough black and white document that a company is required to submit to the regulators. Remember, the 10K document filing is mandatory for every public company. There was a time when annual reports would arrive by post at your doorstep, and that distinguished you as a savvy stock investor. That is no longer the case now. Most annual reports nowadays are either emailed online or you are provided with a link to read the annual report on the company website. Go to the website of the company, click Investors Relation, and figure out the annual reports or quarterly reports. You can also read the annual reports on SEBI's website. To understand annual reports of the company, we should look at the 8 segments of the annual report that offer an in-depth and incisive analysis of the annual report of a company. Besides annual report analysis, you should also know the golden rule of circle of competence. Make sure you fully understand how the business operates, how it makes money, and the future sustainability of the business model and profits before buying its stocks. Directors' Report. This is the first relevant segment of the annual report where the board of directors puts out the key business themes of the year and analysis of the financial performance, key return parameters. This segment is important because it provides you a quick analysis of how the company top brass looks at the business, and that is perhaps the best way for you to judge the attractiveness or otherwise of the business you are invested in. As said by Pearl Dew, a strategic board has a view of looking ahead, an insight to look deeper, and competency to look beyond. Management discussion and analysis. Management discussion and analysis is perhaps the most important part of an annual report. Reputed companies take great pains to reveal the true picture of the present and the future of the company through management discussion and analysis. This segment focuses less on financials and more on the business environment, the strategies of the company, the emerging structure of competition, the game plan of the company in the coming years, the implications, etc. Vision and mission statement of the company. Nothing gives you a better understanding about the quality of the management than the vision and mission statement of the company. Good companies survive on profitability, but great companies thrive due to their vision and mission. A mission statement is something the company applies to its strategy and products on a regular basis. The vision statement is where the management sees the business in the overall social and business hierarchy. Income statement and balance sheet. The proof of the pudding lies in the eating. The income statement and the balance sheet are the flow and stock of the business. It shows you how profitable the business is and how much return on assets the company is generating. Don't just read the raw numbers on the financial, but also read the notes to the accounts. Remember, a lot of the devil in any company's financial statement lies in the fine print, and the notes to accounts contain all the fine print of the company's annual statements. Cash flow statement. Your company may have generated fantastic profits, but is that really generating profits for the business? That is what cash flow statement is all about. It is divided into three sub-segments, namely cash flow from operations, cash flow from investing, and cash flow from financing. The purpose is to see to what extent the positive cash flow from operations are sufficient to finance the negative cash flow from investing, and what is the shortfall that has to be funded by cash flows from financing. This statement is the best summary of the health and sustainability of the business you are invested in. Contingent liabilities and auditor qualifications, if any. What are contingent liabilities? They are called off-balance sheet items. These are not liabilities but have the potential to become liabilities subject to certain conditions. For example, the company may have given a guarantee which will become a liability if the borrower defaults. The company may have legal cases pending against it which could become a liability if the case is lost. Many companies try to use off-balance sheet funding to make the balance sheet look attractive, as Enron did before going bankrupt. You need to watch out for that. Report on corporate governance. Corporate governance is all about ensuring that the actions of the promoters and management of the company are aligned to the interests of the minority shareholders. The annual report is statutorily required to give a corporate governance report based on the discussions of the Corporate Governance Committee. This gives you a fantastic insight about the alignment of the management actions with the shareholder interests. This report also highlights the standards of ethics followed by the company. Normally, it has been observed that companies that adhere to high standards of corporate governance tend to get better valuations in the market. Information on shares of the company. The annual report is also required to make a disclosure of information on shares, which includes the averaging trading price and the average trading volumes. The report also gives the statement of ownership shifts. This is critical. You can gauge if the promoter stake is gradually reducing or if major institutions are selling out. These can be red flags for you. In a nutshell, the annual report of a company is a storehouse of information and insights about the company. As an investor, you must spend the time and energy to go through the finer aspects of the report. Remember Warren Buffett's famous quote, "When I took a look at company's annual report, if I don't understand it, they don't want me to understand it."